Now, you were talking about, I was listening to one of your podcasts, and you were talking about agreement for sale.
Right.
And I've heard of it, but it sounds like that's a strategy that you guys use often out in Edmonton. Can you kind of maybe explain that to the listeners? I mean, I know they've done it here, obviously, out here in Ontario or anywhere really in Canada, but I don't see it happening that often out here. Or maybe I'm just not aware of it happening that often out here.
It's not as common in Ontario because there's not as many lawyers who understand it.
Okay.
And, my mentor, Barry McGuire, who taught us everything we know, he's gone out for a couple of courses out there and tried to explain it. But, it's difficult. There's lots of people that want to do it because this strategy is phenomenal. Like, surprise, more Ontario investors haven't been endorsing this or asking for it. The difficulty is you got to find enough lawyers across the province who can transact. You need a buying lawyer and a selling lawyer. So if you don't have the lawyers who understand it, it's never going to happen. But agreement for sales, they are a seller financing strategy, very similar to VTB, except the mortgage and the title stays in the seller's name, which is pretty cool. You don't need to qualify for the mortgage. And it doesn't matter how much equity, because in a lot of cases with VTB, like if you wanted 85 or 80% financing or whatever, 90% financing with a VTB, the seller would have to have that equity, right? They would have to have that equity in order to lend it to you. In this scenario, what we're doing in Alberta and Edmonton, the seller could have zero equity. They could owe exactly what their house is worth, and they can still seller finance it to us. It's a completely separate agreement. So we're able to set whatever terms we want, right? We can set the amortization, the interest rate, the payments, et cetera. In a lot of cases, we actually set it up to be exactly the same as the underlying mortgage. So if they've got a 25-year, $300,000 house at 3%, it's exactly the same here. And then every payment, we make a payment to them and they make a payment to their mortgage. So our mortgage with them, mortgage agreement with them, goes down at the exact same rate as theirs. So theoretically, what that creates is we get the mortgage pay down. And in a lot of cases, like for myself, most of mine are over 5 years. I've got one that's 10 years where they're carrying a mortgage in their name and title for 10 years for me. So I get 10 years worth of mortgage pay down, cash flow, and appreciation.
And why would somebody want to do that? If I'm a seller, what's
motivation.
The advantage?
There needs to be some sort of a motivation. And what we're doing is we're solving problems, right? I can't just go up to someone on MLS and say, hey, how about instead of, me buying this traditionally, you close out your mortgage, transfer title to me, and you get your $30,000 worth of equity. How about instead you carry the mortgage for another 5 to 10 years for me, and I'll give you your $30,000 later. I mean, there's no motivation for that. So me specifically, I strategically focus on the low equity, no equity situations where someone doesn't have enough equity to pay a realtor. For whatever reason, they need to leave now, whether it be relocation, job loss, and they're in a horrible situation where they don't have any equity. They can't pay a realtor. They got it up for sale by owner. If they sell their home, a lot of big mortgage banks, they charge big penalties if you cancel a fixed term early, right? It depends. I mean, sometimes it's 3 months interest or it's the interest rate differential, which I'm sure you're familiar with. Depending on how much time you have left in that 5-year fixed term, it could be anywhere as high as $25,000 in cancellation fees.
Yeah, those differential ones can be
Horrible.
big fees. Absolutely, yeah, and obviously depending on where the interest rates are, if you're in an interest rate, let's say 3%, and then when you go to break it, interest rates are 2%, you're going to pay that differential. Just kind of let everybody know, right, what that could be. And you're right, it could be up to $25,000.
The bank wants what they're owed. You committed to 5 years.
Right. For that
they're
rate.
Expecting that profit, that interest profit. So they're going to get what they're owed. If you're going to cancel, they'll let you out. There's going to be a big penalty. So, I mean, that's the specific scenario or that I focus on. I mean, there's lots of different ways you can, and I'll go through a couple maybe, but it's all about helping people out of situation. And because of the skills and expertise that I've learned and developed, I'm able to solve their problem and inherit their problem, but I know what to do with it, right? I know that I can take that house and I can turn it into a rental for 10 years. I can find a rent-to-own buyer to close on it, right? So now that 5 years, I'm going to do a 5-year rent-to-own that's going to that's going to last the whole term. So I don't have to cover anything, maintenance, repairs, or anything. The rent to own tenant buyer is going to.
Right. So
So
now that
saving pretty much.
seller now leaves the home,
Yep.
and then now you have to now pay this mortgage payment,
Property
right?
taxes, insurance, everything. I'm
Right.
100% liable for the property.
And
It's
let's say
delayed
now,
title.
right. And so let's throw some numbers out. So let's say now you're paying, let's say your payments are $1,000.
Yeah.
Okay. Now what do you do next?
Well, first things first, I want to find someone to make those payments. So either a renter or a tenant buyer, right? So I find a tenant,
All right.
and they pay me a rent, right? I take, that money, I pay the seller, my agreement for sale seller, their mortgage payments, and they pay the mortgage that's underlying. I pay the property taxes, insurance, and everything else, and I'm 100% liable for it.
Right.
100% responsible. They have no liability whatsoever anymore. It's a
Right.
done sale. It's a delayed title transfer essentially.
Got it. So now this new tenant moves in, they're paying $1,500 a month.
Yep.
You're going to get that cash flow of $500 a month.
Mm-hmm.
You haven't even gone on title. You haven't even put down a down payment.
Oh, I didn't even mention that. A lot of them that I go after are zero
Yeah.
money down. I mean,
Right.
if they got a little bit of, maybe they got a little bit of equity, or let's say they need the damage deposit for their rental or something to help them move on, then sure, we'll throw them a couple $1,000s to help them. And in other circumstances, they may have equity in the property. Maybe they've got $30,000-$40,000 with equity, but in a lot of scenarios, we'll negotiate how much they want now and how much do you want later. And there needs to be some sort of motivation for them to leave that there. Maybe I'm paying a premium top dollar for the property, and they're looking at, well, I can make an extra $10,000-$15,000 on this house by waiting for my money for 5 years. It's not a
Got
bad
it.
return.
No.
15,000 on 45, to 33% returning your money.
And that's how you get into real estate investing with no money down,
Oh,
no
it's so
credit.
cool, man. It's so
Right.
cool.
And I love this, right? And so this is great for a lot of people who are thinking about getting into real estate investing and they don't have any money. Because you'll see things on social media, Facebook, Instagram, and people are just discounting it. There's no way you can get into real estate investing with no money. Yes, traditionally, but if you are creative, you can, which is what you're really kind of going through right now, which I think is brilliant. Now,
Yeah.
now let's kind of just fast forward a bit. So now your tenant's in there.
Mhm.
They've been there now for, I don't know, whatever, say 4 years. Let's kind of walk us through how do you complete that now? What does that look like?
Well, I will say this is not a lease option. So with an option, if you're familiar with something like
Yeah.
rent to own,
Yeah.
the buyer is not obligated to. Now, with an agreement for sale, we are obligated to. It's a signed agreement. So we have multiple ways that we can close on it. One way would be to just qualify for our own mortgage, right? So if the mortgage was 300 and over the 5 years he paid down $60,000 and the mortgage is now 240, I need to close on that 240. So I can go to a bank and say, hey, I need a mortgage for 240,000. I can close that way.
Right.
Another way that I can do it is I can go and find a buyer. I can throw it on MLS because I have a buyer's interest in it. I can put it on MLS and sell it, and then sell it to someone else, and then I get the difference. So I need to pay back the seller what I owe them, 240, and whatever I sell it for, the spread from that is my profits.
Right.
Lastly, you can put a tenant buyer on, which kind of you have a guaranteed buyer at the end, right?
Mm-hmm.
So what you can, they would be closing on it. They'd be renting it from you for the whole period. And then at the end, you already have an agreed price with them that you've written down in your option contract, and they would just close on it.
Yeah, that's great. So I mean, now at the end, even if you haven't, let's say if you are an investor and you still don't have your credit where it needs to be, or you still don't have that down payment, you don't have to even close on it. You can just put it to the open market potentially.
Yeah, or find a
Right.
JV partner.
Yeah.
Sure.
Yeah, that's great.
Yeah, I mean,
Go on.
this can be used in so many different ways, not just as rental properties. You can use it for flips too. You don't need a long-term agreement for sale. You might only need 6 months to a month, to a year. In that scenario, you might be able to give a seller, especially when you're hustling, trying to find a good deal for a flip, and you're trying to grind them down on the price to the lowest so you can make profit off of it. You might be able to give them a little bit more based on the fact they're going to carry financing at like 2.5%, 3%. If you're a flipper, you're probably going off to some private lender at 12, 15%. Think about how much extra interest you're paying over that 4 to 6 months. So it's kind of six and a half dozen. You can pay an extra $10,000 in interest, or you can pay the seller an extra $10,000 and ask for 1 year worth of financing.
Right. So are you doing a lot of these deals? Is this how you got into real estate investing?
I hit that wall around the second or third property where I'm like, okay, I got no GV prospects. I'm out of money. I need to figure something out. And, just out of the blue, you know, buy real estate for no money down. I mean, their advertising wasn't like that, but, that's what I was looking for. And I found a course and I started learning how to do it and I implemented it. We did enough transactions that we were comfortable with because just a small caveat, like a lot of the houses that we're buying were bought by homeowners. So they have high ratio mortgages, 95% LTV. So
Right.
their mortgage payments are quite high. And based on that, the rent doesn't always cover the expenses. Maybe it's negative $100, $200 a month. So you can only take on so many before, as a business, you're floating quite a bit. So
Right.
it's a great opportunity, but at the same time, you need to balance your risk.
Right. That's yeah, listen, I think it's a great strategy. And listen, yeah, and you've got to take advantage of obviously the marketplace of where you are and use it to your advantage, right? So
Well, yeah, we were talking about how boring, Edmonton was, but at the same time, think of all the opportunities that we have here because of that, because of people that are COVID. I mean, people losing their jobs, being laid off, deferred payments are ending right now. We were just talking about that. Deferrals
yep.
are ending. CERB just finished a couple weeks ago too. So, I mean, people are kind of going back to EI. There's a lot of uncertainty and the jobs haven't completely come back yet. Not
Right.
all of them. So there's a lot of people who bought a house a year or 2 years ago thinking that everything was great. And now they're in a situation where they have to sell. So there's huge opportunities for investors in this market to take advantage of that. Not necessarily take advantage of that, but to help people and to build a portfolio at the same time.
Right. And what you're real, I think, and I know exactly what you're saying, right? It's just a win-win. You're helping somebody get out of a sticky situation that they're in, and then you're getting into the market because you're a real estate investor and you want to, you know, uh, create opportunity for yourself.
Isn't that the greatest way to make money?
Absolutely.
To
Absolutely.
help people at the same time?
It's always a win-win. Win-win is always great, right?